English. Thank you. It's my pleasure and honor to to monitor or to serve as a moderator for this first session of the first conference organized by the French regulatory body on the hotly debated topic of cryptocurrencies or crypto assets and ICOs. This session is the quote-unquote academic one, and we should be aware, as Christian already warned us, that on the theoretical side, the field is really in its early infancy. For example, we still lack good theoretical economic underpinnings of why those assets and why IPOs simply exist, and what are the consequences or implication or impact of the mere existence of these assets or currencies on the general equilibrium of financial intermediation and the general equilibrium of asset prices. So so far, we cannot expect to have a full grasp of what's going on. But we can proceed by necessary steps. And our three speakers today, I'm going to talk very little. Our three speakers today will help understand the characteristics of those IPOs or cryptocurrencies. So we should be grateful for them for those necessary and finely done steps. Broadly speaking, cryptocurrencies are based on the complex technology of blockchain, initiated by Bitcoin in 2008, are characterized by the following aspects. Global availability to internet users, speed and irreversibility of transaction, ability to hide identity, potentially high returns and benefits from enhanced portfolio diversification, but also by high volatility, maybe low liquidity, we'll see that, opaqueness regarding price formation and liquidity, and high risk of fraud and scams. So based on those considerations, our three papers will unfold in the following way. First of all, Professor, sorry for the pronunciation, Giancarlo Giudizi, professor of the School of Management of Politecnico di Milano, will uncover the main characteristics of 935 ICOs around the world and assess the probability of a given ICO to be a success using a subsample of those 935 experiments. Second, Professor Armin Schwinbacher from Schema School of Management, Business School, then will investigate the information disclosure of 503 ICOs, so ICOs again, and explore the link between two things. The link between the amount and type of information provided by the ICO and the amount of funds thereby raised. And the second link, in more detail, the link between this information disclosure and the probability of fraud. Last but not least, Professor Hermann Elandner from Humboldt University in Berlin will not consider ICOs per se, but will, to some extent, have a broader vision and analyze cryptocurrencies from a different perspective as a novel class of alternative investment offering new risk-return trade-off. In economic terms, probably those new assets complete the market, and it's a very good thing that the market be completed. and he will focus on the liquidity of their markets to gauge their resiliency to the return shocks they do experience. So each speaker will have 15 minutes. Afterwards, I will have a very brief comment and 1 or 2 questions, and that should leave roughly 15 minutes to the floor for final questions after the 3 speakers have delivered their talks. So, Giancarlo, the floor is yours.
Madame et Messieurs, bonjour. C'est un plaisir d'être ici. But now I switch to English because my French is terrible. Sorry for that. My name is Giancarlo Giudice. I teach corporate finance at the School of Management of Politecnico di Milano. And I'm going to introduce you the main results of a paper we just published on the Journal of Economics and Business that is addressing, as Patrice said, the probability of an ICO to be successful to raise money. So if we can start with the presentation. Okay, here we are. It should work in some place. Where should I?
Where should we aim?
Or if someone can help me, just I will tell you when go on. Okay, so I just say go on. Okay. Okay, so this is just a very short introduction about ICOs, because maybe we are not everyone is familiar with what we mean with ICO. And by definition, I'm an engineer, and so I love definitions. And first of all, it's better to define what we are talking for. Should work now? No. All right. Okay, just say okay. And thank you. Our definition, there is not a definition in the literature, so there is a rush for, so not very. Okay, I just say go on. So go back. Please go back. Okay. So there is not a definition, and there are some working papers around just introducing a definition. Our definition is an initial coin offering is just a public offering made on the internet to raise money in the form of a cryptocurrency, releasing a token. And what can you do with the token? Many different things. Sometimes you can do nothing. It's just very similar to the model of reward-based crowdfunding, in which you raise money from the crowd, in this case fiat money, so euro or dollars, and in exchange for nothing. Or you can use the token in exchange for a product, for example, to use a software, to use a cloud computing solution that will be developed by the ICO team. Or sometimes, and this is the most tricky situation for the authorities regulating and supervising on the market, sometimes it's a security, because the token will allow you to have a return or to share the profits of the project. So this is our definition. And it's a brand new phenomenon, because as you can see from the slide, ICOs were virtually not existing up to 2017. Meanwhile, cryptocurrencies are existing for many years, but as we will see also from the tables, the initial coin offering wave is quite recent because, okay, we will try, this is another one. Because the Bitcoin is not so good to engage with an ICO, we had to wait up to the Ethereum blockchain and other blockchain, which allow the so-called smart contracts. The smart contracts are fundamental in order to organize and to manage an ICO. So ICO is a very recent phenomenon. We collected some data. We have a very smart group of students and graduating engineers at Polytechnic. We were able to raise data from about 1,000 now at the moment of initial coin offering. But as you can see, most of them relate to 2017. Of which many of these, we will see about 80% claimed to have raised the money, so to be successful. They claim because it's very difficult, since we are outside of any regulation, there is no need to involve a bank to raise the money, which is the situation for traditional IPOs, for example. You do not need credit card companies to manage because the payment is made through the blockchain. And so it's very difficult to understand if the money that they claim to raise, it's exactly the amount of money they say. Now let's go next one. This is just a table with the largest ICOs that have been developed up to the moment. As the chairman at the beginning says, we have very relevant cases of projects that raised a lot of money. So with no doubts, and we have seen also in newspapers, there are many scams. There are also people going away with the money. We have market authorities, for example, in the US, the Securities and Exchange Commission issuing fines and forbidding to engage in ICOs each time there is a security placement, each time there is an investment. But with no doubt, ICOs have the potential to be an interesting opportunity for startup companies and teams, entrepreneurial teams, to raise money. So these teams typically belong to several countries. We had a look at the nationality of the proponents, and we find with no surprise that many of them are from the US, but Russia is also an interesting place to engage in an ICO. They have Telegram, which is a company we've tried as well to engage with an ICO. We have UK, we have Singapore and Switzerland. As you can see, there are many countries that at the moment are trying to attract also entrepreneurial teams and investors in the blockchain industry and cryptocurrency. And Singapore and Switzerland are among these. Also the Baltic countries are investing a lot in order to attract entrepreneurs. For example, in Italy, given that the rules regulation is so uncertain, I know that there are some people and entrepreneurial teams that went to Ticino, that went to Switzerland in order to develop an ICO because it's a more friendly environment. So the role of the market authorities is very important in attracting or avoiding or leaving also entrepreneurs to go abroad. And the blockchain adopted most of the times is the Ethereum blockchain because it allows more than the Bitcoin technology to develop smart contracts and to organize an ICO. But we have also cases, about 80% of the sample, in which the ICO is developing its own blockchain in order to manage the tokens offered at the ICO. So we have two different technological solutions. I can rely on existing blockchain, most of the times Ethereum or Waves, or I can develop, it's more costly, but I can develop my own blockchain for the management of the tokens. In most of the cases, the ICO stage is the first one. It's the first round, but we have also cases of a follow-up or more often, 18.6% of the cases, a pre-sale. Pre-sale means that there is a first stage, a first round in which the proponents raise money typically from a selected group of investors, and then they open up in a second round to the general public, typically raising more money. In some cases, we have bonuses that are given to the contributors. So as you can see, several features are common to other kinds of offerings. We can think also about initial public offering of securities, of shares, but by far, initial coin offerings are more similar to crowdfunding. And even in crowdfunding campaigns, we have also cases of pre-sales or bonuses. Bonuses means that, for example, if you contribute with a larger amount of money, you will have more benefits. This is the major contribution option. Early bird means that if you are among the first to contribute in the ICO, you get better conditions compared to the follow-up people. And this is also very important because we will see it's a determinant of the success of the IPO. If the source code is released, this is good for the probability of success of the ICO, and in about 58.8% of the cases, there is the commitment from the ICO team to disclose the source of the blockchain, of the technological solution they are going to implement, of the smart contract. And you can think that maybe this is a problem for the proponent team because they release information, they can be copied. It's like in the open source paradigm, you release information to the public. But this can be also a kind of signal of certification about the quality of the ICO, because the contributors can understand that behind the team there is some work. So some work has been already done, and the project is not a scam. And most of the times this is made through a repository. I'm not an expert on informatics. I got the minimum vote at the school, at the engineering graduation in informatics, but there is a kind of repository which is called the GitHub, and in which many of the teams will publish and made available to the other contributors the source code of the program. And what the proponents are willing to make with the money raised. As you can see, the objectives of an ICO are very different. In some cases, the objective is to open a marketplace or an exchange, typically for cryptocurrencies, or fintech services, 11% of the cases. We have cases of investments, and the use of token in an ICO is very interesting for organizing an investment vehicle, something which is not probably not allowed in the European Union and the US, but in other countries it can be made. And it works like this. We issue tokens and we raise money. So then we invest the money into something, which can be, for example, a venture capital fund, or we buy other kind of assets. And then we commit in the future, thanks to the profits and the return of the investments, to buy back the tokens. And so by buying back the tokens, it's like when we pay dividends. Yes, it's like when we pay dividends. It's like when we give back money to the investors. So this is the scheme that it's used to replicate a venture capital fund with an ICO. Then we have high-tech services, payment solutions, smart contracts, gaming. There are some projects which raised money just to develop a game, and with the token you can access to the game. We can be part of the community of gamers in the future. We have also some adult entertainment services, but just minority of the projects. So what can you do with the token? We have seen the objective. Now, what can we do with the token? In some cases, the token can be used as a currency. So there is an exchange. very interesting for tokens, you can have a secondary market thanks to the blockchain system. And this is another interesting difference compared to crowdfunding. For example, equity crowdfunding, because when you invest into equity crowdfunding, typically you have securities of an unlisted company. It's not a liquid investment. The company is not listed, so it's difficult to have a secondary market. In Italy, for example, this is not allowed. If you invest into an unlisted company, and then you want to sell the shares, you have to go to a notary, you have to go to an accountant, and you have to leave on his table something like at least 300 euro. It means that you invested, if you invested 300 euro, you have already lost your money. But with the blockchain system, this is possible. There is a secondary market, so you can use the token as a currency. You can use in many times, 79% of the cases, the token to access to the platform services. For example, the example of the game I told you before. The ICO project is to release a game, and with the token I can use I can play with the game. Governance decisions, not so often, only 14% of the cases. If you have the token and you invested into the ICO, you have some governance rights, which means you can decide for something which is related to the project, to the management of the project, and 26% profit rights. That is similar to investing into a commodity. You can have a part of the sharing the profits, the benefits of the project. Then we collected also some data about the secondary market, number of contributors. On average, the ICOs up to now have been very successful because there is a strong correlation with the strong market momentum of the cryptocurrencies 2017, for sure. And it's interesting also to see the underpricing. What is the underpricing? In the IPO literature, underpricing is the first day return of the shares. So since there is a secondary market for the tokens, and many people invested in ICOs, and they also traded with the tokens in the aftermarket, sometimes also realizing a good profit, because you see that the average return is very high. If we look at the median value, which is more representative, it's still plus 23%. This means that more than 50% of the ICOs exhibited a positive return. So now, very briefly, as I told you, you can find this paper on the internet. We made a research about the determinants of the success of the IPOs, of the ICOs. 81% were able to raise the money. So it makes sense to understand the variables which are mostly related to the probability of the success. In this paper, we introduced variables related to information asymmetry. For example, if there is a white paper disclosed, the white paper is a kind of prospectus, which is not approved by anyone. So you have to trust about the contents, but it's still a set of information you can rely on to have some reduction in the information asymmetry. And then we checked also for other parameters we have seen before, if there is a pre-sale, if there is a bonus for investors. We also controlled for the social capital of the proponents. There is a huge literature. Armin knows about the human capital in crowdfunding deals. And so we had a look for the first time also on ICOs. And, well, we ran the regression, but this is not very interesting for you, the results of the regression. And by the end, we found that there is an interesting relationship with the programming code. This means that there is a statistical significant relationship with the fact that the source is released. So if there is the availability of the code for the developers, this is related to a larger probability of succeeding in raising the money. If there is a pre-sale, if there is a bonus, probability of success will increase. And interesting also the human capital. So the team size is relevant. The larger is the team size, the larger is the probability to raise money. and also if you studied previously in a prestigious university. So we had a look also at the CV of the proponents, and if they studied before in a prestigious university, probability of success is larger. We did not find a significant relationship with social capital measures. For example, if the proponents have a lot of connections on social networks, LinkedIn, and so on. Now, my time is over, but just to leave you some messages. As many other technology booms, ICOs experienced an initial hype, and many projects will be probably classified as scam. But most of the projects are related to 2017, so we have to wait and certify if they were able to deliver the results expected and perspective to the investors in the ICO. Yet it is another step towards disintermediation of fundraising, without any doubt. Smart contracts could be useful to implement typical provisions requested by investors and by entrepreneurs, for example, tag-along, drag-along rights, veto power, liquidation preferences, or the carried interest in a venture capital fund. So it's a very interesting technology that can be useful for the development of entrepreneurial finance, especially for startups. But yet, and this is not my field, since I told you I'm an engineer, and regulation and transparencies are for sure needed, so welcome for these events. I'm very proud to have been invited by a market authority, yet not the Italian market authority, but the French market authority, so thank you.
So, grazie mille, Giancarlo, for this presentation, very lively. I think we learned a lot of things. In particular, we now have a systematic framework for analyzing ICO's characteristics. Time is passing by very quickly. Just 2 questions. Well, to me, the main wrap-up is that, not surprisingly, probability of success does really depend on the quality of information and the quality of exposed services, including bonuses and possibly early birds benefits. 2 quick questions. Considering the exponential growth alluded to by Christian earlier of this business, Giancarlo, how do you see evolving the future characteristics of new IPOs? ICOs, sorry. Maybe it's a revealing lapsus. ICOs. And my second question is, what can you infer from this analysis, for instance, failure or success, about the future performance of the startup that launched the ICO?
It's very tough. There are 2 different tough questions because it's always difficult to forecast and to try to understand what's going on in the future. But I would say that probably we are seeing something which is very similar to the dot-com bubble in the 90s. Because I remember 1998 and 1999, first month of 2000, each time there was something finishing with .com, it was a success. So there was also a nice academic study from a colleague from New York stating that each time there was a company listed on the exchange and just added .com to the name, they have a huge return on the market. With nothing changes, just the name. So probably it was something similar. We have seen a fashion. Many try to go on the market with ICOs. It is estimated that now there are around something like 700 different cryptocurrencies and tokens on the market available for investors. And for sure there will be a selection. So first of all, we will probably see market authorities, but we will hear in the next, regulating this kind of market, because I think it's not in the interest of the European Union believe that entrepreneurs will go in other countries or will use other jurisdictions just to raise money to engage in an ICO. The technology is good. So everyone thinks that there is a positive effect of the technology, and technology can bring some benefits. But on the other side, we have to protect investors. So the real question is, how can we protect investors? How can we convince and try to promote best, how to say, the best practices in the industry, as to release information to investors, as to avoid that someone will simply run away with the money. So to go back to your first question, how the industry will develop in the future, probably we will see a further development of smart contracts, and the open source paradigm is supporting this idea, because we will see teams opening up to everyone the possibility to enrich the set of instruments and contracts that can be implemented with an ICO. So we will see a technological evolution on one side, and probably on the other side, we will see also a development of the and the standardizations of the information that will be released. But more than regulation, I think that the moral suasion and diffusion of best practice will support the market.
Thank you very much. So, Amin, the floor is yours.
Okay, thank you very much.
So, 15 minutes.
Great, okay, thanks. I have my watch here, so I should be fine. Thank you very much for this kind invitation. So it's a pleasure to talk here about ICOs and information disclosure and fraud cases. Giancarlo already made a very good introduction, so I'm not going to repeat many of the aspects he has said, but perhaps some background on this is Giancarlo and I, we come from crowdfunding area, so our view, and this is certainly my view, is that the comparison is often not so much about ICO with IPOs, but ICO with crowdfunding. And having been also in discussion for regulation in the past about equity crowdfunding, I do see here a lot of repetition. A lot of discussion that is currently going on about regulation is exactly the same thing we had a couple of years ago. When I started being interested in crowdfunding in 2007, there were no platforms. Kickstarter was not there, Indiegogo was not there, Anaxago, YSeed were not there. Companies just set up their own website. It was very much disorganized, not at all standardized, and very quickly platforms arose and standardized this, professionalized it, centralized the KYZ methodology and so on. So I wouldn't be surprised that very quickly this market can have similar developments as the crowdfunding area. And even at that time, just as you have said before, in 2007 we had no clear idea how to classify crowdfunding. Now we have a clear classification about equity, reward, and so on. But I remember a picture I have made from my office with PhD students where we had taken a number of cases of crowdfunding and we tried to classify how should we classify all these weird cases. And very quickly things have converged towards certain methodology. And I think here again, a lot can be learned from what we have experienced in equity crowdfunding and crowdfunding more generally. So I guess I need to click on my next slide. So again, from the entrepreneur finance perspective, this ICO is well taken because it's an opportunity to provide more funding to early stage finance companies. Obviously, new a phenomenon that we have also seen in crowdfunding that has also appeared in ICOs are fraud cases. The first fraud cases appeared. They will definitely affect also the market reputation overall, because there's also always a risk that they spill over to the entire market. So that's where it becomes very important to understand relatively quickly what are the sources of fraud cases, what type of fraud cases are there, and see what can be done. Internationally, different regulatory regimes have been, or approaches have been adopted. Some countries prefer to ban it. Others, like in France, is more of an approach that wants to see what can be done to promote some of these events. But clearly, there's a difficulty in finding the right balance between costs and benefits. Crowdfunding was even more severe because the amounts were much smaller. So if someone comes and wants to raise 100,000 euros, this is almost peanut compared to what we're talking about today. And they're imposing a bit of information disclosure is already very costly. Here the amounts are quite different, so the balance that we could strike are potentially different. So what we have done in this study, this is work with Lars Horno from the University of Bremen, is to attempt to understand the different forms of fraud and whether there are chances to detect them. Again, we think this is important for proper design of potential regulation. One thing that we discovered is how difficult it is actually to detect them. Not just ex ante when they do the ICO, but actually afterwards also. A lot of cases are, someone shouts scam, and then we would think this is a scam. What we did is taking a more conservative approach and actually look at very carefully whether there is serious suspicion of it. Often people use the word scam for just a failed project, but we know startups have a high failure rate also. So some of them are called scam, but are actually just failed projects, but there's no specific reason to think that there was a misrepresentation early on that would, for us, qualify as a fraud. So I'll tell you how we identify them, and our sample is much smaller than you may expect. Others take a different methodology and get much more at the benefit of making sure everything is inside, but at the risk of putting in the sample also a lot of cases that are probably not real fraud cases. So some put already as a fraud case if there's some plagiarism of the white paper, massive plagiarism. In economics, we know what plagiarism is also, but we know also that in white papers, there are a lot of templates being used, so that plagiarism is not necessarily a case of fraud. I just wanted to, there are a lot of fraud cases that could be shown. I just want to show one that is often makes people laugh, but actually it's not funny. But so this is one case of Benibit, some of you may know. So this is, so they raised $2 million, and this is the team. So you have the CEO, you have the CFO, and so on. And later on, someone discovered that these pictures are not the real people. So someone saw that's actually, they took it from a website from a high school in the UK. So you can see the CFO, the lady Victoria, has a position in this high school. And John, the CEO, also has a position in that school. So they faked the team. And the way they faked it is they just took somewhere randomly on a UK high school pictures and then mirror imaged this. And people figure out the fraud because of the fact that they realize that these are not the right pictures probably. Okay, so and that's very surprising as a case, but we have seen a couple of them that are equally surprising in terms of how much you can have there. So we need to define what fraud is. Again, it's very difficult. One of the difficulties because it's very recent. So many of the fraud cases, we're only going to discover them a bit later. Giancarlo has shown the statistics. The bulk of of the ICOs have taken place in 2017 or early 2018. So some of the fraud cases are detected very quickly, others will take some time. So again, our methodology was very conservative to ensure some reliability. We adopted a methodology that has been used in crowdfunding based on certain keywords that help us to capture them and eventually then read all of this documentation that we collected to identify fraud cases. I'm not going to go into the methodology here, but again, we have been trying to really eliminate the cases that are not obvious. So our cases are really suspected, seriously suspected fraud cases, and actually 90% of them are currently also investigated by one of the national regulators, which is not one of our criteria, but many of them, or 90% of them, are currently investigated by regulators. So on top of this, we have also collected, since we're going to look at the cases of fraud and non-fraud to see how we can predict fraud, we also collected a large sample of ICOs, which is turns out to be half of the sample of Giancarlo. But there's an important thing is that it's very difficult to collect these ICO, all of them. And what turns out is that a lot of them are also very local-based ICOs, and often not even in English. They can be in Chinese, in Indian, in Vietnamese, in French, German would work for me, but otherwise it's going to be very difficult. So ours takes the major platform, so we have 503 cases. And for these, we try to establish different indicators that are viewed in the literature or in blogs or by regulators as potentially red flags. So we have been looking at what kind of things are identified as red flags. One example of red flag you often hear on ICOs is whether there's a hard cap. So some of them, they take as much money as they can get. That would be often viewed as a suspicious case, while the availability of a hard cap is considered as less likely to be a fraud. So we wanted to investigate these different red flags. And so we looked also at writing style, ease of reading index, grade level, availability of specific information, whether we do have information about the founders, information on privacy, on legal information, typology, where the money goes for. Many of them don't even say what they're going to do with the money. And also things like figures, charts, tables, pictures, whatever you can think of, pictures on humans, and so on. So that's about the full sample. For the first sample about the fraud cases that we have identified, there are 40 of them that are classified as really serious fraud cases. And what we have been trying to do here is to classify them. So you will see from my presentation that there's no unique way to classify them very specifically. So some of them will be classified in more than one case simply because there is possibility to have more types. So one form of fraud, which is just a regular fraud. The regular fraud is like a Ponzi scheme or clear misrepresentation of the nature of the business. Some of them have a clear misrepresentation that suggests that they have a clear intention from the beginning to get into fraud, even to do potentially a Ponzi scheme. Other fraud cases are less severe, potentially for the investors, but could also be sometimes the case. They're just securities fraud. So securities frauds doesn't necessarily mean that people lost money, but it means that they should have registered at the security regulators, but did not do so. From the perspective of the securities regulator, this would be a securities fraud. But what we have also seen is that very often when they commit securities fraud, there's also another type of fraud involved. Then there's exit fraud. Exit fraud is when they run away with the money. So they take the money, leave immediately. It's a hit and run. So they essentially misappropriate the funds. Then you have pretended hacks. So these are cases where again, these are suspected frauds, but there is the case that suddenly the issuer comes in front of the crowd, the investors, and say, sorry, we just have been hacked, and some money is gone. So we don't know whether, whether this is intentionally or unintentionally from the side of the issuer, but there is some money being lost by the investors, and some of them may potentially, so they are on the investigation to see to which extent issuers have been involved in the hack. The same thing with phishing attack. There have been some that have been attacked, or been affected by phishing. So people send to investors a wrong address where to send the money. And these fraudsters are not necessarily the founders, but it could be. And the last one is the pump and dump schemes, where you do an ICO, and at the end of the ICO, you go to see the people and say, I'm sorry, I just have a very bad news to tell you. And this brings down the price of the token to half or whatever, and people lose money. Whether this was intentional or not is often very difficult to verify, but this essentially, if there is a strong presumption that this was intentional, then this would be qualifying as a fraud. So time is running, I see. So let me not go to this analysis, the first analysis, which is about the success drivers, because Giancarlo has already mentioned it. But let's rather go directly on the fraud cases. So when we match the two samples and look at which percentage is in our case fraud cases, there are not so many. Again, we take a very conservative approach here. Some of them may eventually become serious fraud cases later on, but there are not so many that are, from our perspective, serious fraud cases in terms of number of cases. However, we find that those that are classified as fraud raised by far more money than those that are not classified as fraud. So if you weight this in terms of dollar amounts or euro amounts, then can go up to a very big amount. In our case, it would be up to 16% of the money. Again, doesn't mean that 60% of the money is gone, but it concerns the volume of it. So very often in a fraud, not 100% of the money is gone. So it's not 16% of it, but it's the magnitude in terms of fraud cases. We have seen, so again, if we look at the sample differences, ICOs that are classified by us by a fraud raised on average $74 million, while those not, 10 millions. One thing that we have seen is that fraud cases are much less likely ICOs are much less likely to be classified as a fraud if there have been early contributors or pre-sales. Pre-sales are often involve the participation of institutional investors, venture capital fund. It seems to be a strong signal that have been doing some due diligence in advance, and this helps raising more money, but also to reduce the risk of fraud. The other thing that we have seen from the large battery of indicators that I've shown you is that almost nothing is significant. Okay, it's very difficult to predict. The only thing that we clearly see is that fraud cases have less often reported what they're going to do with the money. This is the only big indicator that we could see as a predictor of fraud. So overall, it seems that it's not so much about the quantity of information, but more the quality. The difficulty about the quality is that just like in crowdfunding, equity crowdfunding, but also in general IPOs, is that people who do not understand how the ICO process works, who are not able to do proper due diligence, will find it very difficult to estimate the quality of information. To see the difference in terms of quality, you need to be an expert. You need to understand the ICO process, but you also need to be able to do a communication and ask the right questions in form of due diligence, something that VCs do, but that the crowd is not able to do. Not so much in equity crowdfunding, not so much here either. There are a couple of other cases, and then I'll wrap it up. That we have seen that are not in our sample, but that are potentially very big. Also, they're more local fraud cases, and there we have seen quite a number. Just to give you one example, which strikes because of the number. So this is Modern Tech. Modern Tech was a fraudulent case where the backers lost $660 million. So this hasn't got a lot of visibility for a very simple reason, because it was only advertised in Vietnam. And in contrast to most other ICOs, it was not so much online communication, but it was direct conferences in remote places. And people ran away with the money. So there are a lot of also not globally advertised ICOs, but nationally or local ones. And these ones are much more difficult to track, but they're equivalently big in terms of fraud cases. Thank you very much.
I'm sorry to be the bad guy here by imposing constraints on time. Thank you very much, Armin, for this stimulating presentation. I have 3 general comments and 2-3 questions. First, I would like to say that it's very difficult in 15 minutes to pay justice to the extraordinary, enormous amount of work that those 3 papers, and that was true for Giancarlo, that will be true for Herman, represent. It's an enormous work, and I want to tell that. Second, it's reconforting that 2 independent studies by Giancarlo and Armin come up with roughly the same conclusions as to success and failure, the importance of information quality, and the importance of the presence of pre-sales of love money and so on. Third, I would like to highlight the fact that the sheer number of type of fraud strikes me as reflecting the amazing bad boys' imagination, the fraudsters. It's kind of worrying to some respect. The quick questions are the following. I noticed that the role of Ethereum is huge and increasing, and the role of Bitcoin is very small and decreasing. So do you have any rational explanation for that? My second question is, in view of the exponential growth of this market, do you anticipate a stability, increase or decrease in the number of frauds in the future? And third, which is more technical, what kind of robustness checks could you or would you consider to confirm your results?
Oh, thank you for these comments and also for the questions. So let me start with the stability. So we have indeed seen that this is a market that is growing very quickly. Obviously, when the market is growing, it's easier to get fraudulent cases on the market because people get excited, and it's easier to. There's more money also that is flowing into it. I think that I've also seen some entrepreneurs who are very keen in getting to are looking for regulation that give them some legal certainty about it, and they're willing to play the game of doing the most transparent way of dealing with ICOs, because they have true projects. And I think for these ones, it's necessary to have some good regulatory framework that promotes their case and allows them to select out of the big sample. There will always be big ICOs also that are smaller ones that will be fraud. Fraud is, you know, it's not specific to that market. When we work in financial markets, we know that fraud can happen from everywhere. The question here is essentially what can be done. And some discussion we had just before is it's difficult to protect people from also stupidity. And this is not the role of regulators. So I think the important is to see whether people can make sound investments as a way to ensure that the good projects can be separated from the bad. But I would say as long as the market is growing very quickly, there's certainly the highest risk also that there will be more fraud cases happening. Ethereum and Bitcoin. Ethereum has the benefit that it's easily usable for others to launch their own coin, while Bitcoin is essentially for transaction. So that has, I think, the big benefit of Ethereum in terms of launching its own ICO. It's also very easy, so I think that's the main reason for having Ethereum taking now about 80% of the market. In terms of robustness, we can talk about later, but I would think one interesting aspect is to have a look at in the future again, where the more cases that have been today not been classified as fraud, but they may take part or may be identified later, whether it is indeed the case. I think to have a true understanding of how important fraud is, we would still have to wait, because some of them just take time. The exit fraud are easy to detect. Securities fraud, well, we have to see how quickly the regulator acts. In the US, the SEC investigates a few of them. They are there. But even then, they stepped in not immediately. And others like Ponzi schemes sometimes take quite a bit of time before they unfold. And that's why I would say the biggest robustness check is to see in the future also how the sample has evolved.
Thank you very much, Armin. So now the floor is to Herman.
Je vous remercie, AMF, très bien. And I will switch to English because my French is certainly not good enough for here. So my name is Herman Elendner. I'm denominationally the professor for private equity at Humboldt-Universität zu Berlin, which is the field that is being superseded by ICOs, we could say, at least in certain regards, certainly not completely. My perspective will be, as has already been initially mentioned by Patrice, what happens to these tokens that have been issued in an ICO after the ICO, basically. Because we have heard a lot about how difficult it is for people to actually even figure out whether they are investing into a legitimate new technology or whether they are actually being defrauded. But these people are trying to make an investment decision in most cases, and we can discuss how much financial education will be necessary to make sure, as we had a very nice way of putting it, to avoid stupidity in these investment decisions, how much regulation is necessary, certainly to a larger degree than we have right now, which is more or less zero until very recently, and how much this actually squares with traditional financial investment decisions, or what we would know from a general application of finance theory, from portfolio management, in how that basically changes how the existence of these cryptocurrencies or assets will change the possibilities of individual investors to structure their portfolio. So we've already started with the objection that we should not be saying cryptocurrencies, although I will go on doing so because this is the standard term that has evolved. Obviously, we are all aware that cryptocurrencies are not currencies. I would actually want to point out that they're not actually cryptos either, because the Greek term of the word would be that they are secret, and I think that may have been true in 2008 or 9, but is certainly true no more. One thing that sometimes gets lost a little bit in the debate about the fraudulent cases and all the problems that we're having is that, in principle, once these tokens hit the market, they are trading in remarkable transparency. As soon as something gets settled on a blockchain, we can follow every single transaction that has been executed on that token. And not all, but almost all of these ICOs do have some blockchain-based technology. So we see actually, with some caveats like pseudonymization or anonymization, but we do see when money is moved, and we do see how these things are traded to a very, very high degree of transparency. So also the exchanges on which these tokens then are usually traded offer a remarkably large degree of information about what is going on their marketplaces. So maybe somebody can inform us what, as an individual investor, I would get in terms of information about stock trading on the French stock exchange if I wanted to see details of the order book, details of order execution, and other information about trading as it is going on. Usually, as a retail investor, you have very limited access here. Crypto exchanges very frequently run a completely open ship where you could see the entire order book, every single potential trade that has happened, that could have happened, where you see a complete track record of every single trade that has been executed in high frequency in real time. This is something for which hedge funds usually pay a large amount of money to get that access. Here in this case, it's usually available for free to everybody. So while unknowledgeable investors who just try to participate of whatever had a large return recently will definitely have a lot of opportunities to be defrauded, knowledgeable investors who do want to do due diligence, who do want to see how an investment decision could be done in an informed setting, will, at least after the ICO, have in many respects a much more open and transparent setting without any regulation already established than is the standard in standard financial markets today. Now, that does not mean that what we've heard before is unimportant. To the contrary, a lot of these schemes are fraudulent. Some are very difficult to tell whether they are. Some are actually very, very obviously frauds. I mean, BitConnect was one of the famous examples where they had literally put a pyramid on their homepage to illustrate the pyramid scheme that they were running. And that was not preventing them from, at the peak, reaching $2 billion of market cap. And it completely collapsed as soon as the SEC basically sent a cease and desist order, because that was certainly kind of too obvious a fraud. And yeah, we could go into details. We can leave that maybe for the discussion. The point is that it was not for a lack of information that this fraud actually was so successful. It was apparently that some people did not want to hear what was already put out transparently. Okay, my focus will rather be how can we reconcile all these things with a standard financial perspective, from a portfolio management perspective, but also from a market microstructure perspective. And we do hear a lot of objections. Until very recently, the economists were very, very critical of all this blockchain. And like Paul Krugman in 2013 already wrote a newspaper article where he basically ideally wished for this to go away. And the lawyers were the ones who were very open initially and started to discussing what that could actually mean, how that could potentially change raising financing, how that could potentially change, even theoretically in some potential ways, monetary policy if the central bank were to adopt certain of these things. I mean, certain central banks are very active in trying to research how they could augment their tool set by issuing a central bank digital currency, but that will be a different topic. One objection has gone away, that they're insignificant. Since 2017, this is an objection that has not been raised anymore. That was what you heard when you were doing research in this field in 2015, 2014, 2016. Everybody told you you're studying something that is too obscure to matter. And what has also been mentioned a few times is that they're very volatile. So even the most conservative, non-fraudulent cases, years after the ICO has been taken place, have a liquidity which is completely on different scales as compared to even very risky stocks. I'm going to show you more about that in a second. Let me briefly try to put this into kind of the bigger picture, because I think that we've seen a surge of attention for technology which actually is in some ways 10 years old and was ignored, especially by economists, for the first 8 of those 10 years. So why do we see so much attention for crypto assets, cryptocurrencies, cryptos, maybe I just say cryptos, now at this point in time? I mean, obviously, first of all, there is a lot of legal, political, societal importance because it does change certain fundamental paradigms at a very, very deep level. So what blockchain is basically enabling is literally the reduction of value to information. And while if we take a big picture view over the last 2 millennia, basically, the history of money has been a history of more and more abstraction. Now, this, in a way, is kind of the next logical step where we abstract away from any physical representation and also from any individual institution which is required to safeguard this information. So even if we have purely electronic money, we still, so far before blockchain, needed some institution to ensure that if we have the information that so and so many euros are lying in my bank account, that this information basically will be kept safe and acknowledged by everybody in the economy. Blockchain is allowing for a way to abstract away even from these central institutions. And that's going to become critical in a minute. So I think that's potentially actually the most important and most far-reaching aspect of cryptos from a big perspective, but it's not the topic of this talk today. So I'd rather move on to the economic relevance. And I think the most important thing here is that, and that's still a contentious claim even among academics, but I would argue that cryptocurrencies or cryptos are establishing a new asset class, which of course has implications for portfolio management if you want to do your asset allocation, allocating certain parts of your wealth to different asset classes. It also has, that has been pointed out by Armin very, very nicely, it has huge implications for the way we finance new projects, new ideas, new startups. The classical way of private equity had a lot of bargaining power with the financiers and very little bargaining power with the startups or with the entrepreneurs, with the inventors. This has been changing a lot with these ICOs, not always for the benefit, because you may wonder what incentive-wise happens if you have somebody who has a great idea and you endow him with 50 million upfront, and then you say, now we trust in your inner ambition to still bring this project forward, to still implement the technology that you've written only maybe a white paper about. I mean, if you look in some of these ICOs, they're doing ICOs before they have a product ready, before they have any kind of prototype. They have an idea, they have a white paper, some of them don't even have that completely, and they already ask for millions. And it's kind of surprising that that should work in its own right? So this disintermediation of the financing of new technological innovations, I think this is a very important change. And here it will be very important to strike a balance with the regulation, which does not kill off the whole thing, but which does prevent the obviously fraudulent cases. Now, coming to the core of what I'm going to talk about, the financial relevance here certainly stems from the fact that over the last couple of years, we've seen very high realized returns with ICOs, but even with just holding crypto assets that have already been issued before. And at the same point in time, these returns have had high volatility, well, that you should expect if they are high on average, but we've also seen very low correlations with traditional financial assets. Now, that means that from a portfolio perspective, that can actually be interesting to include such an asset in your portfolio to reap certain diversification benefits. So let me briefly touch upon the economic relevance in more detail. I've already said that it changes the way we finance new technology ventures. And I think that it's good to keep in mind that the way we usually have been doing this with private equity used to be exactly the one area which did have way higher returns than any other asset class. And it used to also be an area which had kind of persistence in their high returns. About the novel asset class, I'd argue that it's important to consider that a novel asset class because it is the only way we have to finance distributed applications and smart contracts. This wouldn't work with a standard kind of shares or bond setup. And so there is an economic role to be played by these cryptos, and that's the important thing, changing the asset class here. That's the reason why we need something like this to stay if we want to keep these applications alive. Just put some realized returns on Bitcoins, which is the most conservative crypto that you can possibly invest. And you should see that it's not surprising that from a financial perspective, this looks interesting and has attracted a lot of attention. This is just a table to show you very low correlations, close to zero, most not significant with traditional financial assets. And these are volatilities. So on the y-axis, you see the scale. Now this is like, at the upper end, you see 15% per day. This is a completely different ballpark than what you would see from stocks. Let me focus briefly on one particular question. And the question now is, in an environment of so much uncertainty, so much volatility, and so little correlation with other assets, can markets which are trading these cryptos then allocate somewhat efficiently, or do we need to step in with regulation to make that market work in the first place? And I will focus here now on liquidity, that has been mentioned already before, to determine how effective the market is reacting to certain unexpected events that are affecting prices. So liquidity can be studied in different ways, but I'll focus here on a measure which just looks at absolute return changes in proportion to the trading volume. This is a very simple measure of how much impact on prices does a certain trading volume have. So larger measure means more illiquidity, more liquidity means smaller numbers. And if you look at the numbers of these cryptos, you see that they are generally very, very illiquid. Numbers should be in a single-digit range for stocks. We see here numbers of 40, 50. So in principle, cryptos are still very illiquid. If we look at the most important cryptocurrencies and the recent past, we see that this liquidity has improved a lot. So Bitcoin, for instance, is now on a comparable scale like large tech stocks in terms of liquidity already. So let me give you one small analysis to showcase my main point here. What we're running here is figuring out the relation of this illiquidity to large unexpected shocks on returns. So what happens when news come out and the Bitcoin price drops by 50% in a day, which happens? First, we need to take out the standard part. So there are some cyclicalities, some patterns. This regression will take care of the effect of holidays, year fixed effects, monthly cyclicality to distill abnormal liquidity. And then we can run a regression of abnormal liquidity to returns and past returns and changes to abnormal liquidity in the past. So the question basically is, you see a shock coming, market prices change a lot. How do future changes of prices become affected by this sudden change at a certain given point in time? Now, in very efficient markets, we would want to have all the information be incorporated immediately and no effect on further later reactions. Now, even for stock markets, we don't see this perfect efficiency. So while we've heard before that we may want to complete the markets more, I'd argue they're never really complete, and even stock markets are not perfectly efficient. You do see for stock markets, I've added here the pluses to show you what the signs are that we know from the standard financial literature on stock markets. We see that shocks to certain stock prices do affect returns over a couple of days to come. And liquidity also takes a couple of days to replenish, basically. For Bitcoin, particularly, you see no such effect on lagged returns. Basically, the entire effect is priced in immediately with no predictive ability for the return the very next day. You can interpret this in different ways, but it does go also consistent with an interpretation of a quite efficient market, which is incorporating all prices very, very fast. Let's look now particularly at very large and negative shocks, so shocks that are really critically destroying more than 15% or 1.5 standard deviation of the value of the coin. Again, you see that for stocks, you should expect some effects for the following days. For cryptocurrencies, you see that liquidity does take a while to replenish, but you do not see any effect on price predictability for the next days, and you do see that liquidity replenishes quite fast. So let me conclude at this point with the following kind of statements. I think we have seen that cryptos have established themselves as a different asset class already, and the question is how can we add with regulation to stabilize that in a good equilibrium and prevent certain fraud cases that we've seen are abounding. Until they're not yet integrated with standard financial markets, obviously. I mean, you cannot because you mentioned general equilibrium, we certainly are not in a general equilibrium. We wouldn't be able to justify these returns if markets are fully integrated. So what we're seeing here is that in this phase of a lot of capital flowing in to integrate the markets, in this meantime, we see out of equilibrium dynamics with very high returns. As soon as the market is fully integrated, we will not be able to observe these returns kind of going forward in the long run in general equilibrium. But until, like, in line with efficiency, this adjustment process does happen in an unpredictable way. There are no simple ways to tell which projects are going to be scams, which projects are going to succeed. How can I structure a trading strategy to outsmart the market? Markets are efficient enough to prevent these things by and large. Finally, let me conclude with arguing that given that these markets are efficient in certain ways, we should go beyond the traditional ways we try to look at whether a market has been maturing or not. Most people are using until today the measure of market cap. We can discuss in the discussion that that may not be a good measure to use. So what I would suggest here is that maybe liquidity is rather a measure to look at when you want to estimate whether a certain market has reached maturity or is still far away from that. Also important is that we see that these crypto markets are very resilient in the presence of large and unexpected shocks. So while we may need a lot of regulation to prevent investors who are very naively investing in these things, we already see that for those investors who are kind of knowing what they're doing, these markets are working very, very well, surprisingly well, at least from my perspective, given the complete lack of regulation that was present when they were established and kind of really built up. So I think it's really important to strike the balance here and not kind of throw out the baby with the bathwater. A lot of opinions that you hear today are always coming from the fact that this is such a nascent technology and people do not know what they're doing. And it's true there are a lot of engineers there, but I think we should be aware as economists that the economics of these markets are working remarkably well, despite all the problems that happen kind of in parallel. So let me conclude at this.
Vielen Dank, Hermann. We learned, I think, with this paper, lots of lessons, and also we can discard some misconception. For instance, I was amazed by the fact that there is a very low correlation across CC returns, cryptos returns, and across cryptos and other assets. So that comes out as a good news from an investor viewpoint. Since we are running out of time, I will limit my intervention to two quick questions and one observation. My observation is that probably liquidity is extremely heterogeneous across the cryptos that you're considering. Essentially, you showed us results for Bitcoin, but I think for other cryptos, it would be completely different. My two questions are, well, let's say one question. It's to how would you assess, I could ask a question about robustness check, but okay. So the last one would be, how would you assess the welfare gain that we can reap from introducing those cryptos? For instance, one way, and I know, because you just told me half an hour ago that you already started doing that, it would be very nice to draw efficient frontiers of portfolios with and without cryptos to see whether the frontier is placed above and to the east when you introduce CCs. So can you share your experience on that?
Yeah, let me start with the first question first. How about the welfare gains? This is a little bit tricky, and of course it's a more macroeconomic question than I've addressed here, so I cannot give you hard results based on a study. But I think what we know from how the markets work is that this question is certainly a part where crypto markets differ very much from standard financial markets, and it really will also depend on the individual cryptocurrency. Because as we heard in the beginning, the classification of coins or tokens or assets is very heterogeneous, and it may be a certain token which will give you rights to certain services by the firm, like Filecoin, for instance, where with a token you can actually pay for a service that the network is providing. You can have tokens which are more securities. You can have tokens, I mean, Bitcoin basically does not provide you anything other than irrevocable ownership of one coin, and that's it, right? So depending on the individual coin, the welfare gains will accumulate potentially at very different places. If you have a blockchain-based, proof-of-work-based cryptocurrencies like Bitcoin, where money creation basically happens in the hands of miners, you see certainly that a lot of welfare gains happen for those who do have the technology to do the mining, and the returns have been going down due to the strong competition recently, but a lot of welfare was actually gained not for the ones who came up with the network, but for the ones who were operating the network later on. For certain other schemes, the value is kind of generated very much in the firm or in the network protocol runners. I think in the very long run, if you look beyond individual projects or protocols, most value will be generated like with open source, just from the availability of the technology to the population at large. And for Bitcoin, it may not have generated so much value for its founder. I mean, technically, Satoshi said to hold still worth $1 billion or more of Bitcoins, but he's not spending them. In that sense, it may not have generated a lot of wealth for the one who invented the technology, but I think we all agree that he did generate a lot of value by kickstarting a whole wave of research, industry, technology projects, and really new technological possibilities for the population at large. And that is happening globally, right? Now, the second question about the efficient frontier, I think that's very easy to describe. Everybody who's plotted an efficient frontier will know that you have kind of this convex shape where you have the individual assets in there. I've actually put it online, but we have no way to show you right here. Maybe we can put a link on the website below the slide so that if you want, you can interactively play around what happens when you include certain traditional assets. It automatically plots you the efficient frontier, and you click first on Bitcoin, and what you see is that basically a whole old image shrinks to a small part of what used to be the canvas before, and gets extended with much more, with first one additional asset, which has a much higher volatility but expected return, calibrated, of course, on historical data. And then if you include more cryptocurrencies, you see that Bitcoin actually starts to appear very, very conservative, because you keep shifting with more and more risky coins, your frontier further out and up. So in one sentence, if you want to maximize your expected return, you rely on cryptocurrencies heavily. If you want to minimize your variance, you do not need them at all. And if you want to have some trade-off with diversification, you will rely on them for certain small but not insubstantial degree.
Thank you very much. So now the floor may ask questions.
Thank you. Can start. Hi, thank you for this presentation. I have two questions. One academic question, mainly about Bitcoin. Beyond the technical revolution, do you think that Bitcoin gave essence to a new form of organization when people can transact and collaborate together without knowing each other and being in connaissance of a complete information? Second question is about a professional question. Do you think that ICOs present a lot of risks for VC industry, as there is now dilution of the ownership, and there is now diligence? And last point is about the liquidity and the existence of a secondary market.
So, what was the first question again? The three questions are too much for my processing part. Yes, I remember.
Give quick answers.
The quick answer will be, the way you phrased it, I think that technology was the internet. you phrased the question about collaborating distantly and working together. I think that technology is the internet. What Bitcoin is changing is, or the idea of Bitcoin is changing, is the ability to transfer value digitally and remotely. That was not possible. I mean, you couldn't send money by email, right? Bitcoin now gives you, and the whole blockchain technology gives you possibility to send hard economic resources instantly anywhere without any central institution, and in a quite, that's maybe debatable, but in a quite efficient way, I would argue. Smart contracts give you the possibility to solve commitment problems in a novel way that you could not address purely in an electronic framework where you wouldn't know other people entirely at all. The second question was? VC industry. Yes, so I think, again, if you say that, if you phrase the question under the assumption that the VC industry does not change at all, then yes, they're very much in danger. What I think will happen in practice is, of course, that they do not ignore changes in their environment, and that we will see a convergence of the business practices of the VC industry and the ways the crypto community has been financing projects. I think we see that already with ERC20 coins, for instance, where we get a convergence to a way where certain insights from the VC industry are put into the design of ICOs. And certainly, I would not expect that for years to come, just by having a good idea, you can raise $260 million, and then we trust on the benevolence of the inventor that he actually goes and implements the project. The third question was maybe for somebody else.
Well, I could add.
Okay, go ahead.
I would just like to add on this VC industry versus ICO. My understanding is, and again, we had the same question with crowdfunding, is going to replace part or crowd out some of the banking activities or VC's activities or business angel activities. Often I think it starts developing a bit independently of financial players, but very quickly it collaborates and works together the same way as today crowdfunding platforms work very much together with the banking industry, with VCs, with business angels. The same thing with ICO. We see they are more and more participating together with ICOs in form of pre-sales and so on. So I wouldn't be surprised that it's more like complementarity than substitute. Exactly. So that would be my prediction on this.
Hello. Okay.
KYC AML process before the sale or not?
We haven't tracked the KYC.
It's something we do not consider, but it's a good suggestion.
Hello. Question here. Here. Right there. Hello. Thank you for the presentation. I have two quick questions. Since you guys focused on the risk, bad guys, etc., can you give us any case of good execution and nice projects you like? Second question: are you guys personally invested? And what are the good projects? And if you guys are not personally invested, are one of your teams, a person of your team is invested? Thank you.
Okay, let me answer this very quickly first. I think the best project and the best way to go is still by far Bitcoin, for the simple reason that Satoshi came up in a situation where nobody would possibly believe that this could possibly work. And what he achieved was basically what Nick Szabo has called social scalability, right? Starting a paradigm which is completely alien, which, I mean, Paul Krugman would 4 years later write that it can't work, and if it would, it shouldn't. To make that grow without even revealing your identity, just by writing a 9-page paper and supporting it with some code and some comments on some fora, I think that is the best execution that you can think of in the most challenging environment ever. Regarding personal investments...
You just said that Bitcoin has no utility.
No, that I did not say.
But you said that you just have the right to hold one Bitcoin.
I say you have no rights to anything by owning.
I'm sorry, but we have no time.
Okay, sorry.
So the second question, I'm currently not invested because I gave away all the 10 or 15 Bitcoins I owned for a Christmas present, which I wouldn't do today anymore, but back then it wasn't worth that much.
Bonjour, sur votre gauche.
So just one last question, and then we take a break. Two questions, and then we take a break.
J'en ai une là. Bonjour, je voudrais vous poser la question suivante. Quelle est la finalité sociétale des ICO et crypto par les acteurs publics et privés?
The question is about the social relevance of all that.
I do agree with what Herman said before. The blockchain and the technology is a very interesting opportunity for democratization of finance and jobs that traditionally were for professional investors. I would also mention that sometimes professional investors do invest in ICOs. So we have also cases of very relevant and important venture capital funds or investors that joined ICOs, and this can be an interesting signal. But I'm personally convinced that it's the technology, the instrument, is a very good opportunity for democratization, especially in developing countries where it's difficult to access to money.
Okay, one question here, and the final one here.
Yes, but
and this. Okay.
It was the first to raise the hand. He's very angry.
Yeah, but ladies first, so you will be the last one. We are victims of our own success.
Thank you. Do you study the correlation between the economic model, intrinsic, I don't know the word in English, intrinsic of Bitcoin? I'm talking about cost production of Bitcoin and rendement, the growth of the price if you are going on grow value and down value, and the value of the currency on the market and his liquidity. Je sais pas si c'est clair, mais no.
When you talk about currency, is it fiat money or the exchange rate? What do you mean by currency?
I would take the case of Bitcoin. To make Bitcoin work, you have miners, you have a production, and so you have cost production for the system going on, okay? And you have a market who is closed because you have a number of a volume of equity of assets. If is there a correlation between this market and how we product the Bitcoin and how much Bitcoin you have in the market, and his price on the exchange and the liquidity? And there is a...
So the question is basically, does the cost of production of Bitcoins relate to its value? And what you do see, so I have a not completed project where we look into exactly this question with a PhD student. What you do see is that there is a significant correlation between the cost of electricity, which is the main resource consumed for mining, and the activity of mining. So basically, you see that if electricity gets cheaper or more expensive with the fluctuation of electricity prices, you see adjustments to some limited degree, but significant in the mining activity. It's not so easy to see a direct relation on the value of Bitcoin because I think that's determined by other factors.
Okay. You have a mic, so go ahead, and then you.
Thank you for your presentation.
Very quick, please.
It's great to see results we can share. My question was about, you mentioned that the fact that most of the information is really transparent, and for somebody knowledgeable, they can understand everything happening in a project, and they can even discuss with the team and so on. The problem is there is a shift in the sociology of people investing and being involved in the space from 2 years ago to now. And most of your studies are about 2017, where it was a different kind of project than the one we have in 2018. So shouldn't the regulation be focused more on the type of people that get in the space, rather than focusing in general on the operation, to compare the newcomers that are, there are more and more websites that allow people to invest in an ICO more easily and welcoming new kind of people, when the most of the people that made their money with Bitcoin and that I'm investing at the moment are people who are, as you mentioned, knowledgeable and have a good understanding of the field.
Well, I'm afraid your question is more relevant to the regulation part of the conference. So the final question.
Okay, merci. Dominique Guégan from Paris 1. I have a question and a remark concerning the question asked by Patrice, and this is for Herman. So when you ask for the frontier in the portfolio for diversification, you provide some possibility looking at the Bitcoin only in the portfolio. And I think when we want to look at the diversification, you have also to look at the CRISP index, which takes a lot of crypto. And then perhaps the conclusion of that you propose is not exactly the same. It is more balanced, as you say. And it depends also on the way in which you create your portfolio. If you have only some kind of assets or commodities, it will not be exactly the same behavior that we can observe. And now perhaps for the future, it could be also interesting because this meeting is around ICO. So we have tokens now which arrives. And then I think we perhaps don't look at what we can do inside the portfolio with the new tokens. And perhaps this would be also a way to look for diversification with these new tokens.
So thank you for advertising CRIX, the cryptocurrency index that we've developed at Humboldt University, where I've participated in a minor role, and that has been catching on a lot as the market index for cryptos. It is, if you were able to look at the homepage, it is one of the things that you can click, so it is included there. Everything holds that I said, including the CRIX, and maybe we discuss the rest in the coffee break.
Okay, thank you to everybody. And unfortunately, the coffee break will be extremely short.